In this video, we want to look at profitability ratios. Profitability ratios and why is this so important when we are analyzing financial statements? The reason why an organization is in business is because of profits, except it is a non-profit organization. But the major goal of any business is first to make profits. Every other thing is secondary. And that is why analyzing profitability ratios is a must for any business. Why? Because that is the reason why they are in business. So shareholders, investors, lenders, creditors, even business partners, they don't joke with profitability ratios because it shows how well the business is performing. Is it really profitable? That's the question an investor is asking before investing his or her money into a business. So quickly, let's look at it. So what is profitability ratios? Profitability ratios measures how efficiently a business generates profits from revenue, from assets, from equity, and capital employed. I say that again. Profitability ratios measures how efficiently a business generates profits from number one, revenue, number two, assets, number three, equity, number four, capital employed. So it is not just from revenue because that is the one people focus more on. But you also need to look at it. When we look at the profit being generated relative to the assets deployed, relative to the equity invested, relative to capital employed, how well is this business performing? So therefore, we have profitability ratios being divided into two. It's divided into two. We look at the margin ratios and we look at the return ratios. The margin ratios and the return ratios. So what is the margin ratios? Margin ratio simply measures how well a business converts its revenue to profits. That is what margin ratios look at. Measures how a business converts its revenue to profits, into profits. You know, the revenue is the top line in the income statement, while the profits are in stages. So we are looking at each stage. How well is this business converting its revenue to profits? So that is for margin ratios. We are coming back to the examples, but that is what margin ratios is meant to achieve. Then we have the return ratios. This measures how much net profit a business is able to generate relative to its number one, assets, number two, equity, number three, capital employed. So you don't just look at the margin ratios, you look at the return ratios. Shareholders want to know this. Relative to the assets we have invested, relative to the equity we have invested, relative to the capital employed by this business, how much has it been able to generate? So let's look at the examples. Number one example for margin ratios is gross profit margin. Gross profit margin. Some of the margins I would say may not be something you are conversant with, but it is good you know it because investors and shareholders don't joke with EBITDA and EBIT. They look at it. You don't look at any metric in isolation. You look at it hand in hand with other ratios, with other metrics. So there's no metric that you look in isolation, that you assess or evaluate in isolation, except maybe there's something you want to deduct. You want to deduct from that ratio. There is something you are looking for that you want to extract from that ratio. That's when you look at it single-handedly. But in terms of making informed decision for any business, you don't look at a ratio or you don't look at a metric in isolation. So let's move on. So we have the EBITDA margin. You may ask, okay, what is EBITDA margin? Earnings before interest, tax, depreciation, and amortization. We are going to do a calculation on it, and we are going to be using one of the Fortune 500 companies in USA, in United States of America, as our case study. So just stay tuned to this channel. If you are yet to subscribe, kindly do by clicking on the subscribe button and click on the notification bell so you can be notified when we release the videos. So that is for EBITDA margin. Then we look at the operating profits margin. Then we have the EBIT margin. You may ask, but I think operating profit margin and EBIT, which is earning before interest and tax, are the same. Yes, in most cases they are the same, but at times they are different, especially when a business organization have a non-operating income. The moment they bring that into their income statements, then these two are different. Then these two becomes different, because by the time you look at, for instance, Fortune 500 companies, when you look at their financial statement, you will see that the operating profit margin and EBIT margin is different. And don't worry, we are going to be having a case study on it, with a practical example on it, looking at the Fortune 500 company. So what is the last one on this row? On this side, it is the net profit margin. That is the bottom line, the remaining profit at the end. Then we look at the return ratios. The example is return on assets in relative to the assets compared to the assets being invested. What are we getting in return? Then we have the return on equity. Then we have return on capital employed. All these we are going to be having practical example. We are going to do a couple of workings on them. So stay tuned to this channel, just like I said. So if you are yet to subscribe to this channel, kindly do by clicking on the subscribe button and click on the notification bell so you can be notified whenever we release a new video. So we'll meet in our next video. Stay blessed.